Okay, you've heard of hard money lending, you've heard of the Burr method, but can the two of them unlock the true potential in short-term rentals?
The numbers look more favorable to look at this property as a short-term rental. So just through the nature of lending to different real estate professionals, we get in touch with a lot of people who are in the short-term rental space as well.
Let's say that you have equity in your property and an awesome opportunity to add to your portfolio, but you have no time to wait for conventional financing.
We're a partner with you in it as well. We want you to be successful. So we're helping you on the front end do that full cycle evaluation and tell you, hey, this probably doesn't look like something we'd fund because we're seeing red flags here, here, and here.
What if the rules for financing short-term rentals weren't as rigid as you thought? David Little, our guest, reveals the strategies investors are using to scale.
So that was an easy deal for us. We pulled out the equity, we paid him out in a few business days. He's finishing up the flip in California. That'll be done in a month or two. And then once he flips that, the profit margin on that will be more than enough to pay us off on this loan. And he'll be able to finish that project and then pay us off free and clear.
My name is Jason Muth. I'm a 30-time Airbnb superhost. I worked in the media business for over 25 years. In 2016, we started our Chapter 2 through short-term rentals. Since then, we've welcomed over 5,000 guests and their furry friends to our homes. And we are here to show you how to create a smart stay. Now, here's the show. Well, Rory, today, finally, we are talking about financing with short-term rentals, and I'm really excited to have this guest on. He's the co-owner of Crown Capital Resources, and we're going to explore the intersection between hard money lending and the Burr method and short-term rentals. Rory, these are things that we have talked about for many, many years in all of our years of listening to Bigger Pockets, but I didn't realize that this is something that can be applied to the short-term rental world as well.
Yeah. And also, if you're following this string of episodes we've done, we've talked about the limitations when you get to a certain size. And I think we're going to be talking about that today from a different angle, and the financing. Once you've hit a certain size, you acquire a certain number of properties. How can you bust through that ceiling and proceed on and grow your short-term rental empire?
Let's welcome David Little to the Smart Stay Show. David, welcome.
Thank you, Jason. Thank you, Rory. I appreciate you guys having me on. Hopefully I can provide some good insight to your listeners today.
David comes to us from, as they say, the great state of Texas, right? You're in Houston.
Yes, sir.
Are you a native Texan?
I am. I'm from West Texas originally, born and raised in Midland, and then went to A&M and pretty much bounced around Texas since then. But now I call Houston home.
What's A&M stand for? Agriculture and Manufacturing? Mechanical.
Mm-hmm.
Or you probably know that, right?
Big engineering school.
It's the Aggies, right?
That's right. Yeah.
How'd they do this year in football? Do you follow?
Being an Aggie fan is a labor of love. I typically kind of say I have lower expectations and I'll just be surprised on the upside.
I always have to bring football into this. I'm not quite sure why. And I've been watching even more college football these days than ever before. And I never used to watch college football, but so as I mentioned, you're the co-owner of Crown Capital Resources. We actually know some people in common because when we started talking, I learned that you're invested in a company or related to connected to some people that we know that are operating short-term rentals in the Austin area. Yes. How did you find your way from a finance perspective, into the world of short-term rentals?
So a lot of our clients actually, part of the strategy that they use for an exit, they're either refinancing out of the flips that they own or they are selling them. And a lot of times when they run the numbers and they go pull a rental CMA and then they go grab data from, AirDNA, the numbers look more favorable to look at this property as a short-term rental. So just through the nature of lending to different real estate professionals, we get in touch with a lot of people who are in the short-term rental space as well.
The Burr method is well documented in many other podcasts, and I never really thought of it as something that can work for vacation properties. Is this something relatively new that can be applied even in an interest rate environment that we're in today? Or has this just been around for many, many years and we just never really knew it?
I think it is more new. And the reason is because you're seeing more secondary lenders. And when I say secondary lenders, I mean lenders who will loan out for 10, 15, 30 years, long-term lenders. You're seeing more secondary lenders now be willing to look at AirDNA data and say, okay, what's the viability of this from a debt service coverage ratio perspective? Whereas previously, what they wanted to see was either a rental agreement signed or a rental CMA in place. Now you're seeing a lot of them say, okay, what if this is how is this viable from a short-term operating standpoint? So I think as that avenue is opened up, it's allowed people to say, okay, we're going to be able to take out this long-term financing based on this being a short-term rental.
So if this opens the door to better options in the secondary lending space, this increases your confidence as the short-term lender on the space.
Yeah.
When you're underwriting it, are you underwriting it with its potential as a short-term rental, with its potential as a long-term rental, some sort of fusion of both? How are you looking at the property?
Yeah, that's a great question. So the way we think about it is when we're onboarding somebody on the front end or underwriting a property on the front end, whether it's a flip or it's a refi is a bit of a different evaluation. If it's a refi, it has to be a little bit more comprehensive because you have to evaluate the borrower with a little bit of a finer comb. You have to see what's their viability from a credit perspective. Do they have any other bad debt? Do they have any bankruptcy history? Things like that. And then secondly, we go ahead and actually do that back end evaluation as well, and we'll pull some of that data. And if we're a little iffy on it as well, we just reach out to some of our network of underwriters, people who work for some of these longer term lenders, and we'll have them take a second look as well, because we want to make sure that fast forward 4 months, once the renovations are done and they're reappraising this property, that they're going to be able to get the debt service coverage ratio that they have, which today is they need to have a greater than 1. So we do on the front end, we do that back end evaluation as well to take a look at that when it's going to be a refinance.
So let's define debt service coverage ratio and a DSCR loan right now. We have actually we have a couple DSCR loans. Do we have one or two, Rory?
We have two.
We have two. I didn't know if the first one was a DSCR loan, but it is. All right. So we have two DSCR loans. So we kind of went through that process. But just for our audience, from a financial perspective, like what is a DSCR loan?
Yeah, I'm actually, if it's all right, Jason, I'm going to take this a little step back just as a point of comparison. So when you go take out more traditional financing, what the bank is really looking at is they're looking at your credit worthiness as an individual, which primarily revolves around credit score. But then they're also actually looking at the total debt that you have as an individual as well. And once you reach a certain debt to income ratio, then they're not going to give you any more loans. So there's a limitation based on how much money you have and how much debt that you have. DSCR loans are different because they are underwriting based on credit. That requirement is the same, but the ceiling for a debt to income ratio doesn't exist. It's instead a debt service coverage ratio. And so what they're looking at is on a project by project basis, is the cash flow that's coming into this property able to cover the expenses for the property? That's the simplest way to put it. So debt service coverage ratio greater than 1 essentially says that the gross rental income that I'm receiving is greater than my mortgage on the property, and then typically property insurance as well. So it's the P&I and the property taxes as well. So it easy kind of just to put numbers to it. If you're bringing in $1,500 a month in top line rent, then the principal, the interest, the property taxes have to be below $1,500 or below. That would equal a 1. And the reality is when a lot of our clients are starting to look at properties and evaluating their rental position on the tail end, the DSCR ratio for short-term rentals is typically higher than that of saying it's a long-term rental.
Why is it, and I probably know the answer to this question, but I'd love to hear your answer. Like why is it that no other expenses are factored in besides those? Because in running a short-term rental, you're doing more than paying your insurance, taxes, mortgage. You're paying to supply the property. You're paying for capital improvements. You're paying for anything that happens along the way.
It's a really great question. You would think it would be a DSCR ratio of 1.25, right? To say basically there's a 20% overage there. It is surprising to me that is a little bit lower. Um, but those are the qualifications as it is right now. Now, the other thing that's baked in that it's sometimes hard to quantify when you're talking to the lender is whenever they get that AirDNA data too, they have other levers that they can turn to make it a little bit more of a conservative evaluation. So the two levers I know that they can turn is they can mess with, percent occupancy rate. And they say, well, we're just going to be a little bit more conservative on that. Say that the data actually shows us, 65, 70%. Well, we're going to run it at 55%, right? And then the second lever that they typically turn is they actually have kind of credit windows. So what they'll typically speaking, let's say below 600, you're really not viable for a DSCR loan. And then if you're between the last lender I spoke was 630 to 680, you were able to get 65% of the appraised value out. 680 to 720, it was 70, and then I think 720 and above, you were able to pull out 75% of the appraised value there as well. So I think there's other knobs that they can kind of mess with there, but the standard, even today in the tighter lending environment, has typically been one. Was that your experience as well? I'm curious.
Yeah, I forget the actual ratio that they used when we closed the second loan. The first loan, Rory was more involved with that one. It was a much smaller loan. And I do remember toward the end of it, they asked us to up our down payment from 20 to 25%. Did I have that right, Rory?
Right. I forget at this point the actual reason for that, but they did kind of, at the very last minute, change our loan terms. But for the second property, I remember quite well that they gave us loan terms and they used AirDNA, which is, for those listening who haven't heard of AirDNA, AirDNA is an online tool that you can use to estimate the potential short-term rental income on pretty much any property in any market. And I have some, and it's now commonly used, I think, with a lot of short-term rental lenders, which is opening the door, giving them something to substitute long-term rental rents to give people something to underwrite with. But I'm of the view, and feel free to disagree with me, and definitely disagree with me if you do, that AirDNA data is good to notice trends in the market, things that are happening, some strengths and weaknesses in the market. But I haven't found AirDNA data itself to be particularly good with estimating the rental income. In a lot of markets around here, they actually tend to overestimate the rental potentials of properties. So tell me how you use AirDNA data and what you think of it.
Yeah, it has surprisingly become a lot more. The general consensus around AirDNA data is that it's a lot more of a legitimate software in the last 3 years, I'd say. Yeah, we went from several years ago where, like you mentioned, an appraiser wouldn't even look at that realistically, to now that's, from my knowledge, that's the tool that I see them almost exclusively using. Now with underwriting, as with any underwriting, commercial, residential, Airbnb, things like that, the devil's in the details. And so I do think of AirDNA as kind of like a Zillow estimate, right? Or a Redfin estimate. I mean, it's a smattering of data over a zip code or geographic area. And any good operator is going to want to actually go into there and dig with the details. I mean, and the easiest thing with Airbnbs and residential properties is what essentially you want to do is match up the location, the size, and then the general finish out, and find yourself one comparable property and probably hone into 1 to 3 instead of saying what's a neighborhood or what does a zip code look like. So whenever we talk to clients, we ask them as well for a basis of design. Hey, when this is actually a finished product, what are the finishes going to look like? What is the trim out going to look like? Give me an example property that you're saying, hey, this is kind of the vision of what we're going after. And that's very helpful to us.
So we had a situation where a house that we built, which we actually had conventional financing for, and we still own the property, it didn't exist, right? Like there was no rental history on the property. And we didn't get a DSCR loan for that property. We had a standard property, a standard loan through a local bank, and a typical appraiser went out there, and everything was based on the property value, and that's what they lent to us to actually build that property. I just wonder how that would have been a different process if we were looking for, like at the time, I still had a W-2 job, and we still could qualify for this through a typical debt to income loan. But I just wonder how that would have been different had we tried to go through a DSCR loan for a property that literally was nothing. It was a
Yeah.
wooded lot, right, and a plan. Like how do you approach situations like that?
Well, it sounds like what you had that's a huge benefit to you is you actually had the capital to go pursue this project, right? And so when I talk to people about essentially the niche lending product that we offer a product that it allows investors to put minimal capital out of pocket. Our range is 10 to 15% of the purchase price, and then we fund 100% of rehab. And so what we offer is for people to come out, put 10 to 15% down of the purchase. We lend the rest of the purchase and then the full rehab amount. They can then rehab that project. And then at that point, get an appraiser to pull that, to go in there, reappraise the value. And then they're able to pull out anywhere from, 75, maybe 80% of the total new appraised value. And so, it's not always a viable thing. When you're looking at these projects, you're basically saying, I need to be able to, on the tail end of this, pull out if the appraised value times 75%, call it, and then that total amount of capital needs to be able to pay back the lender. But if the metrics all pan out, you do a good job of the renovation, it appraises well, you do have to come up with about 10%, 15% down payment on the front end, but you essentially could get paid back. And it's kind of like a real estate hack. And you can also do this whole system that I just talked about outside of the limitations of having a debt to income ratio. That's the beautiful piece about it. So we have people that have grown. We have one guy who's grown 20 short-term rental properties, and the amount of capital that he's had outstanding with us on any given loan is like $30,000-$40,000. And then he just recycles them. So as it appraises, he pulls the capital back, he goes and delivers another one. So what we provide within Crown Capital Resources is that niche lending service, but also B, we're a partner with you in it as well. We want you to be successful. So we're helping you on the front end do that full cycle evaluation and tell you, hey, this probably doesn't look like something we'd fund because we're seeing red flags here, here, and here, right? So it helps you get, as a real estate investor, it helps you give an opportunity to say, this is another set of eyes on this project. These are maybe some concerns I should have. This might not appraise because our success is your success on this.
Hey, Rory, let's give David a real life example. Another one, like one of ours.
Yeah.
All right, let's play with these. Throw some numbers out there. Okay, so we have a property that I think is worth between $450 and $500. Okay. About $100,000 is outstanding on the loan on that property. We have a super low interest rate on the loan, maybe 3.5%, 30-year loan. I think we're 8 years into it. The payment is much less than the new vehicle that we just purchased on that loan. It does great as a short-term rental, makes probably $75K a year. For a property like that, just those back of the envelope numbers, we look at it and we say, whoa, there's a lot of equity in this property, right? Like, is there a customer profile like that might come to you that says, I want to tap into this equity to go buy another property or do something else? And if so, kind of knowing just the structure of that, just the basic back of the envelope, what is your response as to like what can be done with a new loan product?
Yeah. So typically speaking, there's a large mismatch between capturing a low interest rate like you guys are talking about and pulling the loan out with a hard money lender. Hard money lenders are typically in the 12 to 14% interest range. We're Crown Capital in particular is at 12. So the only people that are in that situation that come to us, they would say something in terms of, hey, I've got $400,000 of equity in this property, or let's put it a different way. The house is worth $500,000 today. It's rented out, it's insured, et cetera, et cetera. I'd like to pull some capital out and I need it within the next 3 business days. So for us, that's an easy deal. We would underwrite it. We could, for this particular example, we could get $350,000 liquid in 2 to 3 business days without issue. Now, the only way you're doing that typically in this example is I just need a few $100,000 to either A, acquire just a screaming deal that I found, or B, I need some working capital to like finish up some of the projects. But typically, and then there's usually a termination on those projects where, hey, I can pay back your loan and I'm all in good standings. But typically speaking, people aren't swapping out low interest debt for high interest debt. It's more so, I've got a lot of equity in this property and I need some capital as soon as possible because I've got this, incredible, opportunity coming up. And so we had that just recently, what you're talking about, a property out in Plano, Texas. A guy had a rental property worth around $600,000. He needed $300,000 to finish a big flip that he had going on in California, and he just run out of capital. So that was an easy deal for us. We pulled out the equity. We paid him out in a few business days. He's finishing up the flip in California. That'll be done in a month or 2. And then once he flips that, the profit margin on that will be more than enough to pay us off on this loan. And he'll be able to finish that project and then pay us off free and clear. So in your scenario that you talked about where you're not permanently shifting low interest debt to high interest debt, it's more so I need to tap into this liquidity and I need to do it immediately.
And the recommendation in that situation, one thing we've always considered is until we decide that we want to get something else and have a better solution for that money, we just let it sit. Because you're right. Like, why would I tap into money at such a high interest rate if I don't have a specific need for that money? Yes. However, what you do is you provide a solution for vacation rental owners like us, where let's say that we have a sweet deal down the street, right? Or in another market, or you name it, where, hey, another market, another property pops up where Rory and I think that we could optimize this property. We know the market really well. We have comps from what we've done in that same market, or just another market that we think that we want to go into, but you need $200K for the down payment or something like that, or that's where you might come in.
That's exactly right. Yep, that's exactly right. And the difference, let me just say one other thing. And the reason we exist too is the speed at which we can work, right? Because everything that I just described, you could do it with a traditional bank. You could say, hey, I'd like to do a cash out refi and things like that, but it's a 30 to 45 day process. One of the niches that we solve, the reasons that we exist is because it's a 2 to 3 day process for us.
Well, and then you're taking that, you're able to fund that so quickly because of either reserves that you have or investors that have invested with you. Is that right on the back end?
Yes, that's correct. So the majority of I would say mid-size private lenders are set up such that they have a pool of investors that are basically earning between 9 and 10%. And then our clients that we lend out at 12%. So we keep the arbitrage between those two and then the origination points as well. So most mid-sized hard money lenders typically work that way.
I know in the traditional hard money lending space, another part of the underwriting is the kind of subjective look at the experience of the borrower and the likelihood that they're going to succeed on their flip or their project. What are you looking for with the short-term rental owners and operators? What kind of experience do you expect them to have? And what are you looking into just to see if they're going to be successful or not?
Yeah, I think you can get a lot of insight. Well, first and foremost, the best case scenario is where somebody can send you their portfolio of properties and you could evaluate it based on that. However, I think there's a lot of value in looking how a client is evaluating something on the front end. The way in which they're looking at something, how conservatively they're running their numbers, have they put into thoughts as to, the design and finish out where they're going to actually procure those materials, what they're going to do for property management solutions and things like that. The way in which a client answers those questions and is prepared for those questions tells me a lot as to the type of operator they're going to be. And I tell people a lot of the biggest issue I see with people who are getting into the short-term rental game is they just want to do everything themselves the first time. And I think there's a lot of wisdom in, especially as you're starting out, hiring out people for different pieces of the project. That ultimately, when I saw that piece is ultimately why we decided to invest in Cribs, is because the value that they bring to the marketplace as a Airbnb property manager is tremendous, especially for, it's tremendous for new people coming on board, but then it's also tremendous for people who are trying to move into actively managing their portfolios and attempting to take a little bit of a step back as well.
When did you become an investor in Cribs?
I think we made a subsequent investment. I think our original investment was approximately 2 years ago.
So if you made an investment then and you made a subsequent investment, theoretically, well, if it was a capital call, that's one thing. But if it was another investment where you really believed in the business, and let's just assume it's the latter, what are some things that you've learned? All right, good. What are some things that you've learned along the way in being involved with a short-term rental management company? Which I'm guessing you're not day to day, but
no, correct.
you're in touch with the operators, and you've probably learned a couple things along the way too.
Yeah. As far as bookings go and whatnot, I think you guys and other, this is a pretty common theme. This is going to be, nobody's going to be surprised by this, but typically speaking right now with the saturation in certain markets within Airbnb, the very homogeneous, just like, gray wall, typical places, they are not booking like they used to. I think that places that provide a bespoke experience, something that when your wife's looking at the 100 different Airbnbs listing, she's excited to go to this one because, there's something unique or exotic or funky about it. Those places are typically still doing pretty well. So that's number one. Like, I think the name of the game right now is differentiation. And then the second piece of it is with an Airbnb is you've really got to keep a very close eye on your operating expenditures. Your costs can really, really run away from you easily. And it's one of those things that you've got to make the right business decision between where do I want to spend some extra money for quality and or service, and where am I not really getting an ROI on my money as I'm thinking about these listings.
Sorry about that. I was taking a look at the AirDNA 2025 Outlook report. I want to get the number right here because we're recording this toward the end of 24. This is coming out in 25. And you make a great point about differentiation. And in markets like Austin, I mean, it's super competitive in that market. I mean, like we're operating in markets that don't have that degree of competition like in Nashville or in Orlando or in Austin, but you can kind of put those in a very similar bucket where you really have to stand out. Like, if you don't have a mural and, cowboy stuff and, something that like, I guess it'd be UT in Austin, but you want things to make it just feel vibrant and colorful and lean into the experience. That is true anywhere. Like a friend of mine is doing he just purchased a short-term rental in the White Mountains in New Hampshire, and he's appointing it right now. And I just saw the name that he picked and kind of like a coming soon color scheme on Instagram. And I thought he hit the nail on the head, like with exactly what he's doing there. And I messaged him and he was shocked that I gave a compliment because I've known him for a while and he doesn't think that I give compliments, but I give compliments, Rory. Don't I give compliments?
Maybe you do. When I see it for the first time, I'll let you know.
No, all right. So here, here's the number. It's on my other screen right here. Like the forecast, available listings, AirDNA, 2023, 1.55 million, 1.655 million, 2024, 1.714 million in 2025. This number continues going up and up and up, right? The occupancy rate, peaked up in 2021 when it was 62%. Now we're back down around a 54%, 55% occupancy rate, which is really what things were, except for that blip, where 2021 was the huge year when nobody could travel internationally. 2022, it came back down a little bit. And now we're at that 54-ish%, 55-ish% of occupancy across the country. The thought is that the market is going to continue to grow. And obviously it's incumbent upon Airbnb and Vrbo to get more people to want to put properties up there, so they have more variety.
Yeah.
But, like the available listings just continues to rise as the platforms want them to do. Theoretically, that's going to take the lower half of the properties that aren't doing so well and push them either further down, right? That they're just not going to be as competitive as all these new ones that are going live, that are learning really how to set up a property correctly. And I've seen some of the ones that Cribs manages, and, like they definitely stand out in the marketplace.
Yeah. And Austin is a hyper competitive marketplace as well. I mean, it does have swings when they have certain events in town and whatnot as well. But for just a median listing throughout the entire year, you have to step out. You have to differentiate yourself. We did the same thing with our listings personally in Ruidoso in New Mexico. And when we looked at the market there, we realized that the average cabin that was being rented it looked like a second home for people, and it looked very weathered and lived in. And we stepped it up, bought some nice furniture, did some really neat design, paneled some walls, made it look really, painted the whole thing, from like a dingy yellow to just bright white. And our listing did tremendously well. But that was the differentiator in that market was just, my wife really said it. She's like, women just want a really nice, clean, chic cabin to go stay in. And that was what we went for. And it wasn't like rocket science in that area, but every area is different. And so you got to look at what's listing in your market and go after that.
What are some of the suggestions you might have as we kind of wrap this episode up about optimizing, rental income potential for a property? We talked about design. Is there anything else that you look at that the good operators are doing to maybe squeeze an extra 10% out each year, which does become very additive and does add up, as you're getting a little bit better every single year?
I think one thing that I've seen work from an operator standpoint, and I mean from a personal standpoint as well, is the companies that tend to do well. They have good marketing set up, and so as you've booked with them, they continue to ping you on, hey, here's what's going on. But they also send these kind of flash deals out as well. And so if you think about it from an operator standpoint, if you have, statistically, if you have a weekend coming up that's historically been a low producing weekend, and you can say, chances are we're just not going to get a booking here. You could send out a flash sale to your email group, say, hey, it's 30% off this weekend, sort of thing. And the likelihood that you're going to now turn a 0% occupancy to 100% occupancy is really, really high. And so the best thing for a Airbnb operator to really understand is what's the marginal cost to have a guest in there for not, right? Because everything in that game, there's fixed costs and there's marginal cost, and really understanding, hey, what's that breakover perspective, and can really help you say, okay, let's figure out how to optimize all these load times. That would be my number one recommendation for Airbnb. And the second thing too is when you're getting into a new market, spend the money and go stay at the number one, the number two, the number three listings, and go figure out, hey, how'd they communicate with you? Go take pictures of their guest book when you get in there. What are some of the touches that you really appreciate? I walked in, there was a handwritten note and a bottle of wine. Because that's going to give you an idea of, hey, if I want to exist in this price point, this is the level of that I have to play at.
And that is a new piece of info that we have not heard. I don't think anyone's mentioned that. That's a great idea.
Yeah.
So crowncapitalresources.com is your website. We will link that up in the show notes. And, if you have any questions for David, you can reach out there and put your social media and things in the show notes as well, so people can reach out to you. Rory will do the same for you. Yes, go ahead.
Can
David.
I make one more comment?
Please
for
do.
The audience, because I know you guys have a nationwide following. We Crown Capital only operates in Texas. However, I'll pass along my contact information. If anyone want to reach out and use another hard money lender, I have connections with people all across the U.S., and I'm happy to send you to the right person as well.
Thank you for volunteering to do that. And
Yeah.
that's certainly kind of you. Hey, Rory, where can people get a hold of you if they want to learn more about lawyering here in the Northeast and short-term rental work?
You can check me out 2 different websites. One is just my name, Rory Gill, rorygill.com, or you can find my law practice, Urban Village Legal. That's urbanvillagelegal.com.
All right. If you have enjoyed this episode, we love 5-star reviews, as we should ask for as short-term rental hosts. We love your comments, and we'd love it if you want to be a guest on the podcast. Go check us out at smartstateshow.com. Fill out the form. Let us know who you are, what you want to talk about, and we'll see if it's the right fit. So David, Rory, thank you so much for all your time today. This has been a great conversation. I've learned a little bit. We threw a little bit of our personal stuff in there, get a little real life example in the situation. And best of luck to you in the new year and beyond.
Thank you, guys.